Welcome to ICICIdirect. Joining us now is Nilesh Shah, Group President and MD of Kotak AMC. Nilesh, you're a veteran of reading budgets, understanding markets, so no better than you to catch on a morning post the budget. It's been a growth-focused budget. India Inc. in markets did seem quite pleased. Inflation concerns, of course, have been ignored for now, despite the backdrop of tightening global liquidity. Your first take, now that you've read the fine print, had a conversation with everyone that matters, how do you think this budget is? Is it fiscally prudent? Is it populist? Or is it actually a balanced budget? No ugly surprises, no disappointments?
So this budget had the shortest budget speech, and it laid the longest roadmap for next centenary year. In a very COVID-19 era, if I have to describe this budget, the finance minister responded with Dolo for infrastructure development, booster for housing, sanitizer for MSME and rural India, and kept social distancing from raising taxes. And more importantly, this budget came PCR negative, that is PM Gati Shakti plus CapEx plus reforms. So overall, this is the budget for accelerating growth through investment. Now, this budget is overly conservative in estimating revenue. The divestment target is down by 1 lakh crore. Small saving collection is down by 1,66,000 crore. And tax revenue estimates are down probably, or not down, but underestimated by between 3 to 4 lakh crore. Now, on top of it, you add cash on hand, and we believe that will be another 1,50,000 crore. We are looking at the underreporting of revenue potentially of somewhere around 7 lakh crore. Now, if you put those numbers in fiscal deficit or gross borrowing program, the entire budget changes. I don't know what is the compulsion on small savings, divestment, tax revenue, or cash utilization. But I believe next year's fiscal deficit could be far lower than what is estimated in the budget if there is no surprise on the expenditure side.
Right, I think it's undercommit and over-deliver is probably what the finance minister is thinking. But Nilesh, I want to talk to you about what this really means for the markets, because it was infra, and that was clearly the biggest theme, right? Do you think this budget now will decisively change the band of the market from growth to value, from high P to perhaps industrial and cyclicals? Could the 30% plus uptick on expenditure change the fortunes of steel, cement, logistic companies? And we saw a bit of that in yesterday's trade. Today as well, the markets are trading in positive territory.
So undoubtedly, investors have taken budget with a lot of positivity. It did dip intra-budget time, but thereafter it recovered sharply. Why is market rejoicing this budget? Partly because this budget has shifted the narrative from giving a fish to a person for survival to teaching him fishing so that he can live on his own. In FY21, when COVID hit us, we increased our subsidy from 2,50,000 crore to 6 lakh crore. We provided 80 crore Indians with free food grains. There was increase in food fertilizer subsidy to support the pandemic impacted economy. Now we are changing the narrative. And my feeling is that this narrative is not limited to just manufacturing. It is actually transgressing agriculture, manufacturing, and fintech. In some sense, this budget is laying the roadmap or building blocks for positioning of India in its centenary year. If you look at agriculture, we are talking about organic farming, chemical-free farming, encouraging oilseeds production, where we remain world's one of the largest importer, pushing millets, which is a healthy food, river linking, and so on and so forth. Despite farm law repeal, which were so progressive and were supposed to benefit farmers, this is a step in the right direction. And it's not that we are only focused on agriculture. Come to the fintech side, 150,000 post offices moving on core banking solution, encouragement to startups and fintechs, launch of central bank digital currency. There is a lot of effort being put to ensure that the FPI flows in private equity, venture capital, unlisted equity continues to support economic recovery. If we come to manufacturing, where we lost out to China in the 80s to become manufacturer to the world, now government is encouraging manufacturing to be in India. Production linked incentive scheme is the step in the right direction. And it's not available only for old manufacturing like auto component. It's also available for futuristic policy like solar panels and technical fibers. So the whole idea in this budget is that government will build on creating infrastructure. It will make policies which are business friendly. And if you are an entrepreneur, either across agriculture or manufacturing or services or of digital economy, you will be able to create growth, leveraging India's policy making and infrastructure.
Right. Well, I want to just get a sense of what happens, and we'll continue to talk about the markets with a very obvious bond market situation that we saw playing out yesterday, which is a reflection of the fiscal concerns. What do you think is going to happen now when a few days from now, the RBI will be having their credit policy? What will this one be all about? Because essentially what the finance minister has done has ignored inflation concerns. I do understand a large function of that could be imported, and it probably might be wiser to focus on growth rather than inflation, which largely is out of your control at this point. What do you think the RBI will do? Will they act upon it? Will they move in tandem with the Fed? Will they be risk takers and support growth and put inflation on the back burner like the government? What are you thinking and expecting from the governor this time around? Yields, of course, are looking a lot higher.
So, Samira, this whole narrative on inflation, I'm not able to understand. Mm-hmm. Today, people are quoting WPI and saying that this is in double digit. Right. But where were all these guys when WPI was negative last year and before that? Mm-hmm. Did they ever mention at that point of time that real interest rates are exorbitantly negative, exorbitantly high? No. So people are taking numbers which suit their convenience, their narrative. Mm-hmm. For last 5 months, Indian inflation at CPI level is lower than American inflation. Now, ask the critics, when did that happen last? When was the time when our inflation was lower than American inflation? There was one report which says that India is facing stagflation. Now, I couldn't understand which economics that was referring to, because as per IMF, we will be growing at the fastest level in the world. There's no major economy in the world which will grow faster than us. So growth is guaranteed. And inflation numbers are lower than American inflation, German inflation. So how can we be in stagflation? And if we are in stagflation, then what other countries are in? So I don't think so. Inflation is a worry. It is well within RBI's comfort zone. And clearly, RBI will have to intervene in the market. This data is a little bit old. It is before the budget. But currently, 1 year and 10-year spread in India is 231 basis points. The historical average is about 70 basis points. The 1 year and 30-year spread today is 295 basis points. Historical average is about 120 basis points. So we are very well discounting rate hikes by RBI of maybe about 5 times to 6 times. Is RBI planning to do that kind of rate hike? Even if tomorrow RBI hikes rate, the 10-year yield and 30-year yield will be in comfortable zone. So clearly RBI has to convince market that you are discounting way ahead of our proposals, our policy direction, and we will intervene in the market to establish the sanity. If RBI decides to intervene at 7%, that will be the cap. If they decide to intervene at 7.5%, that will be the cap. But clearly today, market is waiting for RBI's clarity or direction.
Right. Nilesh, I think one way or the other, the quantum of rate hikes, the quantum of action from the RBI may be debatable right now. But what we do know is cost of capital is going to go up. While the government is pushing India in to take risk, and that's the only way to grow, I believe, in businesses. Uh, from a market perspective, from an investor perspective, we also come out of a year that has been exceptional for Indian equity markets. Do you think it's now time to moderate our expectation of returns, or do you think some of it is probably priced in?
That's a very, very important point, Samina. Our markets are today discount many of the positives in terms of growth, in terms of earning. And hence, it will be extremely important to moderate your return expectation.
Right.
Today, we are valued at about 20 times forward earning. We have differentiated ourselves vis-a-vis Brazil, Russia, China, and South Africa kind of peers. Today, in BRICS, I is separate and rest of the countries are separate. Now, at this premium valuation, can we expect re-rating of valuation? Answer is undoubtedly no. We are already at Mount Everest. How further we can go? With rising interest rates globally as well as locally, will it be fair to expect that our valuations can go up? No. If at all, it should come down. So there is no doubt in my mind that people will have to moderate return expectations. They will have to be ready to accept volatility, and they'll have to increase their time horizon so that they can benefit from the equity markets investment.
Right. Nilesh, then as an equity market investor, how is it that one needs to position their portfolio going ahead in the year, looking at the macros that we've talked about, looking at what the government's focus is, and of course, not ignoring the currency, crude, and the Fed?
So if you're looking at market today, it is discounted certain things.
Right. Yes.
If actual event turns out to be better than that, markets will undoubtedly rise. If actual event turns out to be worse than that, markets will fall. So in the near term, market is discounted that Omicron will not impact economic activity in India. By and large, that seems to be turning out true. The second thing market is discounted is that India Inc. is on its way to roughly about 875 rupee earning per share for Nifty 50 companies in FY23. Now, some people have estimated 850 rupees, some people have estimated 885 rupees. I'm just taking an average of 875. As long as that number is there on the horizon for FY23, I think markets will get supported at every correction. We remain at about 20 times forward earning, which seems justifiable. It's a fair value. Any deviation in that, if 875 becomes 825, obviously markets will correct. If it becomes 900, obviously markets will go up. The third thing is the FPI selling versus domestic buying. Now, for a variety of reasons, FPIs have been booking profit in India. We have outperformed emerging market peers by almost 100% since March 20. We are one of the few countries where FPIs are in profit. Everywhere else, they are in red. So it's quite natural for them to book profit on their overweight India position. Now, these positions which they are selling is getting absorbed by domestic investors. If FPI sell like March, April, May 20 without any price limit, I think there will be sharper corrections in market, but the rebound will be much, much faster, just like 2020. If FPIs continue to sell with price limit like they are doing from October 21 till Jan 22, there will be some correction in the market, more like a time correction than price correction. But a lot of supply of FPIs will be absorbed by strong domestic investor flows. My feeling is that in CY22, FPIs will be a net buyer. They will be buyers probably towards second half of CY22. They'll be sellers in the first half of CY22. But overall, equity markets will get supported by domestic flows as well as FPI flows turning positive in second half. Now, market has already discounted crude prices at 90. If it remains at 90, I think it's there into the prices. If it goes to 100, 120, obviously there will be some adverse effect on the market. So a lot will depend upon how situation spans out relative to what is discounted by the market. Now, the big elephant is the Fed rate increases. There are people who are talking about 3 rate hikes this year. There are people who are talking about 6 rate hikes this year. There are people who are talking about 25 basis point move in March, people talking about 50 basis point move in March. So depending upon how front loaded the US Fed rate increases and how what is the range of Fed rate increases will have some impact on Indian market.
Right.
At best, it will be a temporary transitory impact. At 19,000 Nifty, impact will be much higher. At 16,000 Nifty, impact will be much lower. So we'll have to also look at where we are trading vis-a-vis the rate hike cycle. But at the end of the day, I still believe that every correction is an opportunity to invest in Indian equity. This budget has pushed us on a growth path. India Inc. is fighting fit to create a multi-year earning cycle, and hence an investor taking advantage of correction will be better off.
Right, Nilesh. Thanks for that. Definitely a new age budget. No surprises there, like you said. The markets, of course, have cheered what they've seen. Maybe the growth focus of the government, and maybe in some cases, maybe not commenting too much on other aspects is turning out to be a positive. But always a pleasure talking to you, Nilesh. Thanks a ton.
Thank you.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.